Intuitive Surgical, the company that makes the Da Vinci robotic surgical system that you see here, reported earnings last night and shares are actually down. So what does that mean for investors? Well, we're going to spend the next 10 minutes trying to find that out. My name is Brian Stoffel, and as of the time of this recording, Intuitive Surgical is a stock that I own in my own personal portfolio. I want to give a shout out to Y-Charts for sponsoring today's video. More from them in just a minute. So this was Intuitive Surgical's second quarter of fiscal 2023. The company is valued at about $119 billion today. On the top line, revenue grew 16%. That was slightly ahead of Wall Street's estimates. Non-GAAP earnings per share of $1.42 was up 25% and also ahead of Wall Street's estimates. Let's look at margins. Gross margins dipped ever so slightly. However, that was largely because the company sold more of its systems in international markets where it offers lower prices, so that's not a huge concern, especially because operating margins were actually able to eke up and net margins were up significantly as well. We don't know what the free cash flow was because the company does not release that in their earnings press release and they haven't filed their 10Q, but we do know that GAAP net income grew by over $100 million and the balance sheet is in absolutely stellar shape with $7 billion in cash, no debt. But anyone who follows this company or this industry should know that all of those numbers, while important, pale in comparison to one big figure, and that is procedure growth. How many procedures are being performed using the Da Vinci system? One, because it just shows that it is actually doing well in the medical community, and two, because it has a lot of consumable parts that contribute to its revenue. On that front, there was good news. Procedures grew 22% during the quarter. That was ahead of estimates. That is also above a very healthy benchmark that I have in my head of 15%. They said that U.S. general surgery, which is a catch-all for all surgery that fall outside of gynecology and urology, was strong. So was gynecology for benign conditions. And that general surgery was led by this word right here, which I can't pronounce, and let's admit it, you can't either, but it means gallbladder replacement, as well as hernia repair. They also said that the Ion machine, their new machine that can do lung procedures, showed strength with 145% growth in procedures during the quarter. That is, however, off of a very small base. And the company placed 331 new systems in the second quarter. In other words, there's 331 more Da Vincis in hospitals than was before the quarter started. And that was more than they did in the same quarter last year. And man, look at this. There are now over 8,000, if you combine them all, Da Vinci systems installed throughout the world. That is incredibly important because these are multi-million-dollar machines that hospitals want to use, doctors train on. It improves surgical outcomes, and it forms an enormous moat around Intuitive Surgical's business in the form of high switching costs. And with the trade-in program that the company has, those machines aren't going anywhere anytime soon. But moving on, we can look at the company's income statement and we see that total revenue was up 15%. But as I said, the cost of that revenue was up 17%. That's because up here they charged lower prices because of some international placements. That leads to gross profit that didn't grow quite as fast as revenue. That's not a great sign. However, income from operations was actually up more than revenue, 16.5%, and that's because right here, SG&A and research and development didn't grow as fast as revenue. Great sign. Overall, there was some wonky stuff with income taxes, and that led to net income growing 36%. But this wonky stuff isn't going to show up all the time. So while it's nice to see a 36% jump in net income, this jump in income from operations is more indicative of the profitability direction of the company. And it's also worth pointing out that shares outstanding was down 2%. The company is spending some of that money to buy back shares. Now, if there was any kind of bad news during the call, there was just two things. One, they said that in bariatric surgery, which is under that umbrella of general surgery, some customers are saying that they want to use weight loss drugs before undergoing a bariatric procedure. But that is a small part of their general surgery. Don't love to see that as an investor, but it shouldn't be too big of a deal. And then they also said that there's some pricing pressure in China as a result of government policy and competition. But again, there is a cat and mouse game that they've been playing for years with the government of China, because China has to approve when any new systems are sold within the country. Overall, looking at estimates, management doesn't provide any top or bottom line, but Wall Street's expecting 14% top line growth and 18% on the bottom line. It is worth noting that the company's forecast for procedure growth for the full year was between 18 and 21%, or about 19.5%. They upped that to between 20 and 22%, midpoint of 21. That is a very, very meaningful move, and it shows that this company is executing and this management team knows how to manage expectations. For the full year, no guidance from management, but Wall Street says 15% top line, 17% bottom line growth. What are we going to watch moving forward? Keep an eye on that procedure growth. Look at system placements. You've got over 8,000 installed base. International, see if China is weighing on anything. Keep an eye on those margins. Overall, the moat is no doubt widening around this company, and the thesis is very much on track. Now, the last time Brian Feroldi ran this through his quality score, it got an 82, which is very high. On mine, it got a 10, and you might think that that is somewhat low, but it's worth pointing out that the founding team is no longer there, and because of that, it doesn't get points there or for insider ownership. That's just something that I think is worth checking, but if you don't think that it's as indicative of this company, you can bump that score up to a 12. I think that this is a very, very anti-fragile company, one of the highest quality ones that I have in my portfolio. But what does that mean about valuation? Well, let's look at that. First, we've got to say what stage of its growth is it in. I'd say between stage 4 and stage 5, which means that we can look at price to earnings, price to forward earnings, price to free cash flow, and for that, we can turn to Y charts. Thank you again for sponsoring today's video, Y charts. We use Y charts almost every day. You can start your free trial by clicking on the show notes below and mention Brian Feroldi's name, and you'll get 20% off your subscription. So if we look at the company's PE ratio of 93, that is not cheap in any world, and it is even quite expensive given Intuitive Surgical's past 10 years. If we look at its forward PE, this is just over the past year plus. 62 is very high and pretty high compared to where it's been over the past year. Well, what about price to free cash flow? Man, even there it looks expensive, trading at 121 times free cash flow. We don't have the updated numbers for that yet, but even so, we know that that is very high. Well, is there any other way we can value this? Well, we could use a reverse discounted cash flow analysis, and we have actually built a tool for that purpose. If we head on over here, you can get this spreadsheet and you can type in Intuitive Surgical's ticker symbol. You can type in its free cash flow over the past 12 months. We don't know what it was as of today, but if we take the 4 previous quarters, it was at about $1 billion. We have to set a terminal growth rate because robotic surgery is still in its early innings. I'll put it at 3%. And I think that this is one of the widest moat businesses in my portfolio. So I'm actually okay with just an 8% return per year. That's my discount rate. And then we basically have to just take this and we've got to make the growth rate match these two numbers. It trades for about $340. So if we up that to 20% growth, we're not quite there yet. If we up it to 26% growth, we're almost there. 25% growth, I'd say about 25.5% growth. What this means is that Intuitive Surgical needs to grow its free cash flow at a 25.5% per year for the next 10 years. That means $1 billion right now in 2023, but in 2033, it needs to be about $10 billion. Could it 10x its free cash flow over the next 10 years? My answer to that is it is certainly possible, but that is a mighty, mighty high valuation. Right now, Intuitive Surgical is just a shade under 5% of my portfolio. I stop adding to it once it gets to 5%. These prices are too high for me to add to it now, but I certainly will be looking for a chance to top it off at some point in the future. If I didn't own shares of it at all, I would definitely buy some because this is such a high quality company. This is one of those that you can check in every 90 days. I want to let you know that if you want that reverse discounted cash flow calculator, you can click on the show notes below and you can download a free copy for yourself. Until 90 days from now, when we check back in on Intuitive Surgical, Brian out.